Why the U.S. dollar remains under pressure, data, trends, and market impact. For more than 70 years, the U.S. dollar has been the backbone of the global financial system. It dominates trade, it dominates global reserves, it dominates sovereign debt markets. And yet, despite that dominance, the dollar remains under steady structural pressure. Not collapse, not crisis, not panic, pressure. And in financial systems, pressure is often more important than headlines. So today, we're going to look at the data, the structural trends, and what this actually means for markets going forward. Because the real story is not whether the dollar disappears. The real story is whether its dominance is gradually compressing and how markets reprice when that happens. Let's start with the data. 30 years ago, over 70% of global foreign exchange reserves were held in U.S. dollars. Today, that figure is closer to the high 50% range. Now that is still dominance, but the direction matters more than the level. Reserve currency shifts do not happen overnight. They happen through marginal adjustments. A 2% reallocation here, a small diversification there, a regional trade agreement somewhere else. Individually, these shifts look insignificant. Collectively, they change global capital flows. Second data point, energy trade. For decades, global oil markets were overwhelmingly priced and settled in dollars. This created automatic dollar demand. Energy importers needed dollars. Exporters recycled those dollars into U.S. Treasuries. That recycling mechanism supported bond markets and reinforced dollar strength. Today, some oil transactions are being settled in alternative currencies, not replacing the dollar, but supplementing it. And supplementing is enough to introduce pressure. Third data point, U.S. Treasury demand. The United States continues to run significant fiscal deficits. That requires consistent bond issuance. Bond issuance requires buyers. Historically, foreign central banks absorbed a large portion of that supply. Recently, growth in foreign ownership has slowed. That does not mean foreign investors are abandoning treasuries. It means marginal demand growth is no longer automatic, and markets react to marginal changes. So why is this happening? There are three structural forces at work. First, the rise of multipolar trade. Emerging markets are increasingly trading with each other, not just with the United States. Regional supply chains are expanding. Bilateral trade agreements are becoming more common. As trade becomes more regional, settlement becomes more flexible. Second, geopolitical diversification. In a more fragmented world, countries prefer optionality. Holding multiple reserve currencies reduces dependency risk. This isn't ideological, it's strategic. Third, rising U.S. debt levels. As debt to GDP increases, investors naturally begin asking long-term sustainability questions. Now, this is important. The dollar's strength has always rested on three pillars: deep and liquid capital markets, rule of law and institutional trust, and the size of the U.S. economy. Those pillars still exist. There is no immediate substitute for the scale and liquidity of U.S. Treasury markets, but markets do not wait for a replacement. They price relative advantage. If the relative advantage narrows even slightly, pressure builds. So what does this mean for markets? Let's start with bond yields. If Treasury supply continues rising while foreign demand growth slows, domestic buyers must absorb more issuance. To attract buyers, yields may need to remain elevated. Higher yields increase borrowing costs. Higher borrowing costs slow economic activity. That feedback loop becomes delicate. Next, commodities. A structurally softer dollar environment often supports commodity prices. Gold, in particular, tends to benefit when reserve diversification becomes a theme, not because the dollar collapses, but because central banks diversify incrementally. Energy markets may also reflect settlement diversification trends over time. Now, equities.
A weaker dollar can support multinational corporations that generate foreign revenue. Currency translation boosts earnings, but if higher yields persist alongside dollar pressure, valuation multiples may compress. So the outcome is not one-dimensional, it's complex. Some sectors benefit, others struggle. Now, here's the subtle but critical point. The dollar does not need to collapse to change market behavior. It only needs to lose a fraction of its premium. Reserve currencies rarely fail dramatically. They erode gradually. The British pound did not disappear overnight. It declined over decades. The same pattern tends to repeat: diversification, reduced share, shifted capital flows, higher volatility. History does not repeat exactly, but it rhymes with precision. And what we are observing today is not a crisis, it is a transition. The United States still has the deepest financial markets in the world. Treasuries remain the global collateral foundation. The dollar is still the primary invoicing currency. But dominance can soften without breaking. And when dominance softens, markets adjust quietly at first. Volatility increases, cross-border capital flows rebalance, asset correlations change. The key for investors is not to predict collapse, it is to understand structural pressure. Because pressure reshapes risk premiums, and risk premiums determine asset pricing. The world is not moving away from the dollar abruptly, it is slowly diversifying. And slow diversification is powerful, because by the time the shift becomes obvious, markets have already repriced. The dollar remains central to the global system, but central does not mean unchallenged, and understanding that distinction may be one of the most important macro themes of the next 5 years. Not panic, not collapse, transition. And transitions are where both risk and opportunity live.
Why the dollar remains under pressure, and why markets are quietly repricing it. For decades, the US dollar has been called unshakable. The world trades in it. Central banks hold it. Global debt depends on it. So why is the dollar under pressure, even while it remains dominant? That's the paradox. And in the next few minutes, we're going to unpack what's actually happening beneath the surface. Not headlines, not speculation, but structural shifts. Because the dollar is not collapsing. It's being slowly tested. And tests reveal strength or vulnerability. Let's begin with a simple number. In 2001, the US dollar accounted for over 70% of global foreign exchange reserves. Today, it's closer to the high 50s. Still dominant, but declining. Now here's the first question you should ask. Why does a 10 to 12% decline over 2 decades matter? Because reserve currencies don't change dramatically. They change gradually. And gradual decline changes marginal demand. Marginal demand changes pricing, and pricing changes everything. Let's look at trade flows. Global trade has become more multipolar. China trades heavily with Asia. The Middle East trades more with Asia. Regional blocs are strengthening. When trade patterns shift, settlement patterns shift. Countries begin using local currencies for bilateral trade. That reduces automatic dollar demand. Not dramatically, but consistently. Now pause here. If fewer transactions require dollars, what happens to structural dollar demand over time? It softens, slowly. And markets always watch slow trends carefully. Now let's examine energy. For decades, oil trade reinforced dollar dominance. Energy importers needed dollars. Exporters accumulated dollars. Those dollars recycled into U.S. Treasuries. That recycling loop supported bond demand. But today, some energy contracts are being settled in yuan or other currencies. Not the majority, but enough to matter at the margin. And here's the second important question. What happens when the recycling loop weakens? Treasury demand becomes less automatic.
Now, combine that with rising U.S. debt levels. The United States continues to issue large amounts of sovereign debt. Higher supply requires consistent demand. If foreign central banks grow more cautious, domestic institutions must absorb more supply. To attract capital, yields adjust. Higher yields strengthen the dollar short term, but raise fiscal costs long term. That tension creates structural pressure. Now, let's zoom out. Is this de-dollarization? Not exactly. It's diversification. And diversification doesn't create headlines. It creates drift. Drift in reserve allocations. Drift in settlement systems. Drift in capital flows. Over time, drift becomes trend, and trend becomes repricing. Now here's where markets become sensitive. If the dollar weakens modestly, commodities often rise.
Gold, in particular, tends to benefit when reserve diversification accelerates. Gold doesn't depend on any single government. When central banks increase gold purchases, it often signals hedging behavior, not rebellion, hedging. And hedging reflects uncertainty. Now, let's talk about equities. A softer dollar can support multinational companies with overseas revenue. Currency translation boosts earnings. But if higher yields accompany that softness, valuation pressure increases. This is where complexity enters. Dollar pressure is not uniformly bullish or bearish. It creates cross-currents, and cross-currents increase volatility. Now, ask yourself this. Why hasn't the dollar collapsed already if all this is happening? Because dominance still matters. The U.S. Treasury market remains the deepest liquidity pool in the world. The dollar remains the primary invoicing currency. Global debt markets are overwhelmingly dollar-denominated. There is no immediate replacement. But here's the critical distinction. A currency does not need to collapse to lose premium status. If the dollar shifts from unquestioned dominance to competitive dominance, risk premiums expand. And when risk premiums expand, asset pricing adjusts. Think about it historically. The British pound did not collapse overnight. Its share declined gradually after World War I. Over decades, the system transitioned. Investors who understood the transition early adjusted positioning before the headlines caught up. We may be witnessing a similar dynamic, not collapse, but compression. Compression of dominance, compression of automatic demand, compression of premium valuation, and compression changes capital flows. So, what should markets watch next? 3 indicators. First, Treasury auction demand, especially from foreign buyers. Second, central bank reserve allocation reports. Third, energy settlement agreements between major economies. If reserve managers steadily diversify, even small percentage changes matter, because in global finance, scale amplifies small moves. Now let's return to the bigger picture. The dollar remains central to the global system, but centrality does not equal invulnerability. Geopolitical fragmentation, rising debt, and multipolar trade dynamics create structural tension. Tension doesn't explode immediately. It builds, and markets price tension before headlines confirm it. The dollar is not failing. It is evolving under pressure, and evolution reshapes risk, returns, and correlations. Understanding that evolution before it becomes obvious is where strategic advantage lies, because the most important shifts in finance rarely arrive dramatically. They accumulate quietly, until one day the shift feels obvious, and by then markets have already moved.